Welcome back, class. We have one topic left in valuation of goodwill, which is capitalization method of valuation of goodwill. Here we are going to capitalize the profit, that is, we are going to calculate the capital employed, and thereafter we will calculate the amount of goodwill, right? So here we are going to start. First one is classification. Here capitalization method is divided into two parts. We have already completed average profit, which is also known as future maintainable profit. We have covered the super profit method. So we are going to capitalize super profit and we are going to capitalize average profit. There are two methods. We will calculate goodwill one by one. Okay. For understanding this, here we have two companies, company A and company B. Company A is in normal business and here we are assuming that there is no benefit of goodwill. So the returns are very normal, right? In company B, that it is very reputed business and the profit is above the normal profit. So, on normal return, company A is earning normal profit, and because it has some goodwill and because of the goodwill, the customers get attracted toward the company, so it is earning super profit. So, super profit is the difference, or you can say amount of profit above this normal profit. Assuming that the capital employed in A and B both are same, so the amount earned above normal profit by company B is known as super profit. So in formula term, you can say average maintainable profit or you can say average future maintainable profit minus normal is known as super profit, right? So we are going to capitalize this profit and thereafter we'll calculate goodwill. So let's go to example first and thereafter understand what basically we are doing. So this is one balance sheet of December 2005. We have share capital, profit, loan, creditors, goodwill, land, plant, stock, book debts, cash. Right? So we have some profit also, given some profit, which is of 2001, 2002, 3, 4, 5. Right? And the respective profits 5,40,000, 5,70,000, 6 lakh, 6 lakh 40, and it is in increasing trend, right? The next one is dividend were paid 10% for 2001, 2 and 3, while for 2004 and 5 the rate was 15%. Calculate goodwill assuming the tax rate of 50%, where we are going to use this tax rate to calculate future maintainable profit. So things which are required to calculate here is capital employed, normal rate of return, normal profit, which is based on these two things, capital employed into normal rate of return upon 100. Thereafter, future maintainable profit, the profit of last year 1, 2, 3, 4, 5 here. We will calculate the future maintainable profit, which a business can maintain in future. Thereafter, super profit, how much this company is earning above this normal profit, and thereafter, last one is goodwill, right? So all these things we have calculated in super profit method of goodwill. But here you can see one difference. It is only capital employed, not average capital employed. So the total capital employed you will calculate and thereafter further you will calculate goodwill. So now we are moving to the next slide, which is first one capital employed. How you are going to calculate capital employed? You are going to add all these assets and thereafter external liabilities you are going to reduce, and at the end whatever you will get, that will be your capital employed at the end of the year. Land and building, it is 4,95,000, it is 4,90,000. Plant 10,57,000. So here it is not 10,57,000, but you can see here in the adjustment value of plant is 10,57,000. You added the same over here. Stock 12,50,000. Here it is 12,50,000. Book debts minus reserve. Here it is 8,62,500. And last one is 1 lakh. right? The total of this is, we are going to subtract the sundry liabilities or outsider liabilities. We are going to subtract all the liabilities where the loans, creditors, provision for tax, it is all, we are going to see the difference. The difference will be capital employed for this business. The next one is calculation of normal rate of return. In normal rate of return, there is no specific return is given. So the valuable information here is dividend were paid for 3 years is 10% and for remaining 2 years is 15%. So here you will have to calculate the average rate of return. Here we are assuming that the dividend paid are the rate of return. So three for 3 years it is 10%, for next 2 years it is 15%, right? So here normal rate of return is 12%. What is this normal rate of return indicating? It is indicating that in such similar case of businesses, the business, if applied some capital, it will earn back 12% of return. Next one is normal profit. Capital employed, you calculated earlier. It is not average capital employed. In case here it is capital employed, right? You see, we are here again to understand one thing, that if it is capital average capital employed, you are going to reduce half of current year's profit, right? But it is not average capital employed, it is capital employed. That's why you are not reducing half of the capital employed over here. Okay, half of the profit over here. So what is the normal profit? It is 24,89,500 into 12 upon 100. It is 2,98,740. This is the normal profit. Now we are going to calculate how much profit the company is earning nowadays. So it is future maintainable profit. I have cropped here the adjustments. Here it is written in 2001, 5 lakh 40,000, in 2002, 5 lakh 70,000, 2003, 6 lakh, 6 lakh 40,000 and 7 lakh. Thereafter no adjustment, right? If there is any additional information about the fire, loss, anything, future expenses, we are going to adjust the same. But there is no such adjustment. We are going to add here the average profit. We have added all the profits over here, and profit at the end, the average future maintainable profit is 6,10,000. But one more thing, if you see here, it is written rate of tax is 50%, right? So profit after tax will be 6,10,000 minus 50% of the tax. So the amount here is 3,05,000. Next one is super profit. So you have calculated future maintainable profit which the company is earning. You have calculated the normal profit. The difference between these two will be super profit. 3,05,000 minus 2,97,740 is the super profit. So it is, in case you are going to capitalize super profit, you will calculate till here, right? So under this method which we are reading, we are going to calculate capitalization of super profit method, that is goodwill. Here super profit divided by normal rate of return into 100. What basically this formula is? The super profit is difference between these two, future maintainable profit and normal profit, right? It means excess of this amount is over here. So we are going to calculate the capital of this excess amount, and thereafter we will consider it as goodwill, and the purchasing company will pay it like a goodwill excess to the purchase amount, right? So here your super profit is 6,260 divided by 12, which is normal rate of return, into 100, right? This is the amount for goodwill, right? The next one is capitalization of average profit method. In this average profit method, what you are going to do, you are going to calculate the capital employed of average profit. Here you know average profit is also written as future maintainable profit. It means the extra profit you are earning. In normal case, how much capital was should be employed to earn such kind of profit. So we have calculated on 3,05,000. The capital required was 25,41,066.67. We can round off it this amount also 667, right? But what was the amount here in this question capital employed? It is 24,89,500. So the difference between these two will be the goodwill amount. So in both of the cases, you can see earlier you have here the super profit is the difference between what the extra profit earned and the normal profit. Thereafter, you calculated the capitalized value, and thereafter, in this method, you have calculated the capital employed of the total profit and thereafter deducted from the capital employed in your business. It is the amount. Both the goodwill amount will be similar in both the cases. It was all about capitalization of average profit. So we will meet further in valuation of share.